Hello everyone, my name is 𝐒𝐨𝐥𝐴𝐤 and today I'm going to talk about a tax saving mechanism that when you hear of it, you might tend to think that, it's not for me, okay? But I want to challenge you on that. I want you to stay until the end to hear the whole thing and then decide for yourself whether this tax hack is applicable for you or not. So today, I'm going to discuss donor advised fund. Donor advised fund. This mechanism was established in August of 2006 by an act of Congress, and that act provided the rules and regulations that are required to give this tax savings to people. So the idea is very simple, right? What you do is, let's say you're donating some money every year. Let's take small amounts, okay? Let's say you donate, I don't know, $5,000 every year. And instead of donating them over 5 years, that is $25,000, you take $25,000 deduction for that upfront in the year one. Yes, that is possible. So the way it's possible is that you take that $25,000, give it to a donor advised fund. When you give that money, they keep that money for you and you can get the deduction. And then they start giving that money to your choice of charities as the time passes on. And there's no time limit on it, okay? You can donate money months later, you can donate money years later, you can keep donating in small chunks, however you want it. But the big advantage here is that $25,000 tax deduction can be taken on the year one, the moment you transfer money from your bank account to a donor advised fund. And this is very useful concept, because you could have a year that has exceptionally higher bonus. You could have a year where, your income is just way out of the roof, right? Or something is happening in your life, things are changing, and this year is going to be like extra money that's going to get generated, right? In all of those cases, right, you can use this as a tool. Now there's another advantage besides saving tax or taking that tax deduction upfront, right? And tax deduction upfront means time value of money, right? So the tax deduction that you could have gotten later, if you get it upfront, you can take that money and invest somewhere else. But another important part of this is, when you give this money to donor advised fund, the donor advised fund then invests this money based on your preferences, and the money pot grows. And that means you have more money available for donating from a beginning smaller pot. This is very important concept. And by the way, these companies that run donor advised funds are all really well-known companies. Let me give you some examples. Fidelity Charitable, Vanguard Charitable, Morgan Stanley Gift. You can see that these are all the major brokerage houses, right, that are running charitable portions as well, charitable trust as well. Now, you might say that, well, I don't actually donate even $5,000. I might not donate that much money at all. So this is all useless for me. It's not, because if I give $25,000 somewhere, I might not donate anywhere, ever. That's wrong. Let me give you a use case or an example that a normal upper class, middle class people in LA go through, right? So I have 2 kids in charter schools. Charter schools are free public schools, okay? But they get a little bit less funding than the public schools, neighborhood schools. So they ask for a little bit more donation. Their PTAs ask for a little bit more donation. And the suggested donation for one kid for me, per one kid of that school is $1,800 per year. I have 2 kids in the same school. So then I end up donating $3,600 per year. And let's say I donate $400, $500 somewhere else. So total $4,000 to make it square. So I donate $4,000 per year, no matter what. Now, 4,000 times, I don't know, 6 years, $24,000, right? In 6 years, I've donated $24,000. So even though I'm not a very generous person, right, still I have my donation needs. And imagine that me just putting this $25,000 aside and then taking the tax deduction upfront and then keep donating from that money. Now that money is going to grow because the money is invested. I will have more money for donation available without me putting that much. So this is the beauty of this vehicle, right? Now, that's why I said that, you know, normal middle class or upper middle class people can also use this vehicle. And the contribution limits for many of these are small. You don't need to contribute every year, just do it once. And Vanguard Charitable's limit is $25,000. Morgan Stanley Gift is $25,000. There is another National Philanthropic Trust or something. Their limit is $10,000. So you can start as small as $10,000, right? Now, there are few very important things you need to understand here, okay? One is, once you donate that money to these Vanguard Charitable or Fidelity Charitable, the money is gone from you, okay? You can't get it back ever. Please understand, you can't get it back ever. There is no mechanism like HSA which turns into like, you know, normal IRA kind of vehicle. There's no such thing. You are not getting that money back ever. The grant is permanent. Okay. Another thing is, you cannot benefit personally in any way. The charities that you are giving this money to must be a 501c3 organizations, right? They should be registered with the IRS, right? And gotten that tax exemption, right? No political contributions are allowed, right? Now, international organization donations are allowed. Many of all of these companies or charitable charities have different ways of donating to international charities. So Vanguard routes it through a CAF America, which is an American charity, but it's again a proxy or intermediary in between. Now they might take a little bit of cut in between. Keep that in mind. Okay. There are limits on how much deduction you can take, but those limits are very high. For example, if you donate cash to this charity, Vanguard Charitable, right? You can take up to 60% of your annual gross adjusted gross income. That means if your adjusted gross income is $200,000, then up to $120,000 deduction you can take in the first year. Now, if you donate more than that, then you can carry over these deductions up to 5 years. Okay, but I mean, I don't imagine anyone donating 60% of their annual, gross income, adjusted gross income, to charities. And then another beauty of it, you don't have to donate cash. You can also donate securities or your stock, the stock or your RSU that are appreciated over the years, and then you don't have to pay capital gains tax as well, right? You just transfer those securities from there to your Vanguard Charitable, and then they'll take it over from there, and your donation will be the value of that appreciated value, right? You can take that much deduction, essentially. So securities donation is also allowed, right? And there's no annual payout requirement. That means there's no requirement that every year you must donate this much. And there could be 5 or 10 years you don't donate anything. You can die without donating anything. But then, of course, you can get that money back. Your family can get that money back. Vanguard or Fidelity, whoever they are, they will just donate that money if someone, wherever they want it, right? So that's how this whole vehicle works. It's very simple. It's beautiful. and it gives you upfront tax deduction. And as I told you, a need for such a vehicle exists even for middle class or upper middle class people as well, because don't forget, you donate to your school every year. That's it. Again, my name is Vaibhav Puranik. Our website is oldmoneycapital.com. There is a lot of interesting information on oldmoneycapital.com. You can also go and click on request a call button on the website and set up a call with us, and we can tell you, we can educate you on multifamily syndication, how it works and how it can benefit you. Our YouTube channel is Old Money Capital. Please subscribe to our channel, and our Instagram handle is oldmoneycapital123. Thank you very much.